Okay, so all the way back on the 26th of February, not too long ago, by the way, although for people new to end-of-day trading, it might feel like an eternity, we had just a classic setup, really. I mean, this was such an obvious-looking setup with decent reward to risk. It was a retracement back to this previous level of support testing as resistance, and an obvious symptom of a downward trending market is where previous support is tested as resistance prior to a continuation to the downside. What else looked good about this one? Well, the clues started coming in. Not only is it in a downward overall trend with good order angular separation between the moving averages, this level also coincided with the 0.618 Fibonacci rejection. You see what I just mentioned there about the 200 above the 50 above the 20. So we've got that. We've got good speed and momentum behind this market until we get this rather tedious cross up of the 20. We call it a bullish golden cross, sorry, where we get the 20 moving up above the 50. Then that would be a warning sign. But the fact that it hasn't done that is encouraging. So what we did was we simply placed an order at the break of the low of this evening star, bearish pin bar reversal, high test bar, whatever you like to call it. It's really the same thing, isn't it? It's got a tail and it's got a body, open and close in the bottom third of the bar, and it's testing the 50 moving average, this dynamic level of resistance, which has been tested numerous times before in the past. So you can see how my choice of the 50, 20, and 200 wasn't just any kind of arbitrary number. Certainly, when I see price interacting with these moving averages, it gives us a very good dynamic level of support or resistance, very much like a trend line, except unlike a trend line, the requirement is of moving averages is far less tests for it to be a valid level of dynamic level of support or resistance. A trend line typically need 2 or at least 3 touches or tests in order to qualify as a trend line. With a moving average, all we need is 1 previous test, and that's it. It's been qualified as a dynamic level of support or resistance. Okay, so essentially with the Kiwi dollar, we're in this trend at the moment. Sure enough, we went through what I call purgatory for a good week, where we almost got stopped out of a full hit. But you know what? I mean, this is the daily. You've got to give it some slack. And the great thing about the fact that it was a bearish pin bar reversal was the fact that we were able to put our stop loss snugly behind this point of rejection here. And this is why I like trading pin bar reversals, purely because you can put your stop loss at quite a tactical point at where if the stop loss is triggered and you've made a loss, then the trade setup is well and truly invalid. And there's no real kind of psychological loss from this or emotional loss from this. So now, non-farm payroll, of course, was great for the dollar, not so good for anything paired against the dollar. We're all the way down here. We're up about, if we're risking 2% on this one, we're up about 6-7%. The previous swing low here is our first target, but of course, there's going to be a much longer way to go for the Kiwi dollar. And what I'm going to do is target shoot where I think it could potentially go long term. Please be rest assured that markets can do anything at any time. It might not go down to here, but I do think that it's a very good chance that it could potentially go all the way down to 0.6744. And you know, those people who are in this trade at the moment, it's probably a good idea. What I always say is bank some profit and take half the position off, and then leave the remaining half the position to run, essentially. Okay. I've got a question here. Do you ever counter trend trade? Yes, I do. I trade reversals as well, but that's a different kind of subject for a different webinar. And I believe we talked about reversals before in previous webinars, but it's something I plan to cover again in the future. And yeah, it all depends on your individual style, really. Whether you're a reversal or a trend trader, I like to do both, really, because when I'm right with the reversals, then the rewards can be out of this world, essentially. Okay, so I hope that answers your question. FX Boyke, your familiar name, welcome back. Good to see you. So, okay, so that is the Kiwi dollar. I'm just going to go on very quickly to talk about the Dow. I know this is not currency. I'm sure I won't get into trouble for talking about it, though. Let's hope. So you can see here that looking at the quantitative easing and the fact that we've had all this funny money printed worldwide has perpetuated stock markets to break all-time highs. We're seeing that the Dow, okay, it's in a phase of retracement at the moment, and we're making higher highs and higher lows. We can see this more acutely on the weekly. And yeah, it's quite obvious what we're looking for here. We've got higher highs and higher lows, and we're just waiting for a retracement. We can see that it's tested the 50 moving average before, once, twice, so thrice maybe. Well, to be honest with you, we've got a very good heads up that it could potentially happen again. So we're just waiting for the Dow to come down to the 50 moving average, and we're going to wait for a signal bar to go long and essentially just buy the dip in this upward trending market. Okay, and a lot of people, you see written in all these reports everywhere that stocks in Europe and Britain, UK, and Asia and America overhyped, overinflated. But you know what? We trade what we see, not what we think. And to be honest with you, you'll be reading those kind of publications. I know sometimes we just can't help ourselves as human beings. They serve more harm to our trading because essentially all the analysts in there, I mean, sure enough, they're right at some point in their careers, and no doubt when they are, they'll make a big deal about it. But essentially, it depends on the time frame they're talking about, okay? And there are a lot of people who make these predictions, and that 2010 is going to be the year of the next economic collapse. And, every year since 2008, different pundits at different times have been coming out expressing their grave concern that the stock markets are going to tank yet again to all-time lows, but we just haven't seen it. Okay, we've just been seeing a beautiful trend upwards, and as a technical trader, we need to follow that trend. And I'm talking about the Dow here, but regardless of it being a Dow, just pretend it's a currency pair. It's very straightforward in this sense. I mean, people who trade price action and supply and demand, then this kind of strategy and these principles are relevant to all markets, whether it's currencies, stocks, commodities, you name it. It's just the same principles, but on different a different wrapper, basically. All right, so let's going to move on now. I'm going to move on to Euro GBP. I know this is one which a number of people have been looking at. So here, even on the weekly, we can see that we've been trending very nicely here. Euro GBP, and we've been trending beautifully since 2008. It's a very obvious looking downward trend, and we've been seeing key phase one, key phase two areas. So phase one, sell area, phase two, retracement. We've been a huge phase one again all the way since 2013, where we've just been going down, down, down. We've broken at the bottom side this channel here, and we're just waiting essentially for a pullback in order to simply sell the rally in this case. And if we look on the daily here, we could see that we've got 200, 50, and 20, got good order angle and separation. So we're just simply waiting for some kind of retracement. I know it's easier said than done with a lot of these currency pairs because they're so overextended in a lot of them that we just need to wait for the pullback, unfortunately. But I do want to talk to you a little bit about gold, because this is something which is slightly more relevant, and you could potentially see an opportunity here sooner than you would something like euro, which is grossly overextended. If we look on the, here we go, look on the weekly here. There we go. We've got a downward moving channel here, making gradual lower highs and lower lows. Excuse me, I'll just get some of this clutter off the screen. Gold on the weekly. And we can see here that, okay, we've made very clear lower highs and lower lows as well. So we're on schedule to, based on what the past has done before, make a lower low. So we go down to the daily and we see, okay, so we've got that perspective on the weekly. Do we have an opportunity to potentially get into this one on the daily? Well, we did a few weeks ago, all the way back in, well, I say that, it wasn't that long ago. It was, the 2nd of March. We got this bearish pin bar reversal here. It was simply selling a pullback. There we go. So we knew, by looking at the weekly, that we're due to make a new lower low on the weekly. But on the daily, we're just simply waiting for a breather in order to position or get into a position in order to ride this longer term move. So I know a number of people who actually place their order just below this bearish pin bar reversals low, minus spread, minus an extra dollar, stop loss above the high, etc. And they're just riding it down. Okay. So lo and behold, in the meantime, we could just wait for another pullback, wait for things in this downward trending market to get a little bit better in the form of a retracement or a breather, pullback, whatever you like to call it, before they get worse, and we just need to wait for an activator bar or a signal bar in order to jump in on that move, okay? And this has been just adaptable with the market we have in front of us. I mean, you can see here with the moving averages that we've only just really, I mean, because this trend is so kind of gradual, really, that the moving averages aren't as kind of there's no real separation between them, but they're still valid. There's still separation, they're still angled, and they're still in the right order.